Imagine owning last decade's blockbuster stock, but it's suddenly wearing winter clothes in July. Is that disaster or opportunity? Today we're diving into oil stocks in 2025, value trap or once-in-a-decade buy. Let's break it down. This is Seven Hills Equities, where we simplify investing and personal finance with a sharper edge. Quick reminder, this video is for entertainment and informational purposes only. We are not financial advisors, and none of this is financial advice. Always do your own research before making any investing decisions. If you like straightforward insights and market breakdowns, make sure to like this video and subscribe to Seven Hills Equities. It helps the channel and keeps great content coming. Here's what we're covering today. What's happening in oil right now, the three forces shaping the sector, how to separate traps from opportunities, and 5 ways to play oil stocks smartly in 2025. Let's start with the big picture. Oil prices have been swinging wildly. Renewables are growing fast, and oil majors keep promising they're transitioning. But headlines don't make money. Positioning does. In 2025, oil stocks look cheap on paper. Some are genuinely undervalued, while others are cheap because they deserve to be. The question is whether those reasons are temporary or permanent. To figure that out, we've got 3 key forces driving this story. Number 1, demand resilience. EVs are real, but so is petrochemical demand, aviation, and growth across emerging markets. Global energy demand hasn't collapsed, it's just shifting. Number 2, capital discipline. After the shale boom and bust, producers are finally acting like grown-ups. They're cutting spending, rewarding shareholders, and keeping output in check. That discipline supports dividends, but it also caps upside if oil prices surge. Number 3, geopolitics. A single tanker incident or sanction can move oil prices $20 overnight. That volatility makes oil risky, but it can also be rewarding for investors who position early. Put all 3 together, resilient demand, disciplined supply, and geopolitical tail risk, and you've got the perfect setup for strong opinions and volatile charts. Now, let's get specific with 3 companies that define the sector's range: ExxonMobil, Chevron, and Occidental Petroleum. First up, ExxonMobil, ticker XOM. As of late 2025, Exxon trades around a 16 times price-to-earnings ratio, which is relatively modest compared to the broader market. Its earnings per share over the last 12 months are just above $7, down from nearly $9 in 2023. But over the past 5 years, Exxon averaged double-digit annual earnings growth. It's a giant with strong cash flow and a fortress balance sheet, the classic conservative play in this space. Next, Chevron, ticker CVX. Chevron trades at about 21 times earnings, a noticeable premium to Exxon. Investors are paying more for each dollar of earnings because Chevron carries a bit more production growth potential and slightly higher leverage. Historically, Chevron's earnings growth has been solid but more cyclical. You're getting a company with a strong dividend, exposure to global LNG, and a record of disciplined spending, but you're also paying a premium for that stability. And then there's Occidental Petroleum, ticker OXY. This one's more volatile, with a price-to-earnings ratio hovering near 24 times. Its recent earnings have softened, and cash flow depends heavily on oil staying above $70. But Occidental's balance sheet has improved dramatically since the pandemic, and its carbon capture initiatives give it a unique growth angle. Higher risk, higher potential reward, a classic swing-for-the-fences play in energy. So, 3 distinct personalities. Exxon, the steady dividend anchor. Chevron, the balanced growth operator. And Occidental, the risk-tolerant wildcard. Now let's zoom out again and talk about when cheap is actually dangerous. Here's how to spot a value trap in oil stocks. First, collapsing earnings. If free cash flow only works when oil is at $90, that's not value, that's hope. Second, production chasing. Some companies pump more just to hit short-term cash goals, and that usually kills future margins. Third, regulation and financing risk. Governments are tightening emissions rules, and big banks are restricting fossil lending. That's a squeeze play for weaker operators. Fourth, structural decline. Refiners and integrated majors with aging, high-cost assets can slowly bleed out even while looking cheap on paper. Those are the traps. Now for the other side, why this could still be a once-in-a-decade opportunity. First, free cash flow. Many oil companies are producing record amounts of cash and funneling it straight into buybacks and dividends. That shareholder discipline didn't exist 10 years ago. Second, an investment drought. The world has underinvested in new oil supply for nearly a decade. Basic economics tells us that lower supply with steady demand usually means higher prices later. Third, forced ESG selling. Some funds exited the oil sector purely for optics. That selling pressure can create mispriced bargains for investors willing to look past headlines. Fourth, high-quality assets at low valuations. Buying top-tier reserves for a single-digit multiple doesn't happen often. Bottom line, the fundamentals aren't perfect, but the setup for patient investors looks better than it has in years. Now, if you want to approach this intelligently, here are 5 ways to play oil stocks in 2025. Number 1. Core majors. Companies like Exxon and Chevron offer slower growth, but steady dividends and buybacks. Number 2. Quality independence. Efficient shale operators with low break-even costs move fast in both directions. Number 3. Refiners and midstream players. Refiners can be cash machines when margins widen, and midstream companies act like toll collectors. Number 4. Options or hedges. Covered calls or protective puts can limit risk if prices swing the wrong way. And number 5. Your watch list. Track catalysts like earnings surprises, capex cuts, or merger rumors. Oil changes storylines quickly, so staying alert matters. For most investors, oil exposure shouldn't dominate your portfolio. A small slice, maybe 2 to 6%, is enough to capture upside without wrecking your balance if prices drop. And if you're ever tempted to buy, run this quick checklist. Is free cash flow positive at current prices? Is debt manageable? Is management disciplined with capital spending? Can dividends survive a 20% drop in oil? And finally, is there a real catalyst on the horizon? If most of those are yes, you're not gambling, you're investing. So, value trap or once-in-a-decade buy? The answer depends on your patience, your conviction, and your stomach for volatility. Oil isn't dead, it's just different. Some companies will fade, others will quietly compound wealth for the next decade. Remember, this video is for entertainment and informational purposes only. We are not financial advisors, and nothing here is personalized investment advice. Always do your own research and talk to a professional before making financial decisions. If you found this breakdown useful, hit like, subscribe, and ring the bell to keep up with future content from Seven Hills Equities. Your support helps us keep producing sharp, no-nonsense investing videos. Thanks for watching, and we'll see you in the next one.